Can the income that you generate from an Airbnb help you qualify for a mortgage on another investment property? Let's find out. So let's talk about how Airbnb income affects getting a mortgage on an investment property. Remember, lenders care about verifiable, stable income. That's what it's all about here. When a lender qualifies you for a mortgage, they must prove that any rental income used to help you qualify is predictable, documented, and likely to continue. Because Airbnb income can fluctuate month to month, lenders are cautious. They only count it if it meets strict documentation and history requirements. So there's two main scenarios that we're gonna focus on here. Scenario A, you already own and operate an Airbnb. If you already run a short-term rental and it's been active for 12 to 24 months, you can usually use that income. So lenders require 2 years of tax returns, Schedule E of your IRS Form 1040, showing rental income from the property, or at a minimum, 12 months of documented Airbnb VRBO income from Airbnb statements or a 1099-K form. Remember, it's not yet on your tax return. And if you're wondering what a VRBO is, let me explain that to you now. VRBO stands for Vacation Rentals by Owner. It's a platform like Airbnb where property owners rent out their homes, cabins, condos, or vacation properties to travelers for short stays. VRBO income is simply the money you earn from guests who rent your property through the VRB platform. How it's earned. First, you set your nightly rate, cleaning fee, and rules. Next, guests book through the platform. Then, the VRBO collects payment from the guests, takes a small service fee, roughly 5 to 8%, and deposits the remaining balance into your bank account. So let me give you an example. You have a nightly rate of $200. You have 5 nights booked. The VRBO service at 5% equals $50. So you earn $950 as gross income. Hopefully that example helped you get a better understanding of how the VRBO system works. Now, after the lenders figure that out, what they'll do then is they'll average the income and apply a vacancy expense factor, typically about 75% of the gross income, to qualify you. Because remember, rental rates are not guaranteed. We've talked about this in a previous video, but you can never think that you're going to rent your property out 100% of the time. It's just not realistic, and it never happens. So they're gonna take a 75% ratio and say this is more realistic, assuming we have those 12 to 24 months of previous history in the books. To give you an example, if your Airbnb generated $30,000 last year, a lender might count $22,500 towards qualifying income. Just take 30,000 times it by 0.75, and that comes up with the 22,500. Now that's scenario A. Now let's talk about scenario B. Say you're buying a new property as an Airbnb and you don't have one that's producing any income. This obviously is going to be a little bit trickier. Because you don't have rental history, lenders can't rely on projected Airbnb income for standard conventional loans. So they're obviously not going to count any Airbnb income towards your debt to income ratio at the purchase, unless obviously you qualify for a special type of loan. Let's now focus our attention on the different types of loans and how they actually handle the Airbnb income to qualify you for your next purchase. So under a conventional loan, the income can be used only if it's been documented on your tax returns for at least a 12-month history. No projected income allowed. Then you have what's called a DSCR loan, a debt service coverage ratio loan, and this uses projected Airbnb income from appraisals or rental analysis, and it's very popular with investors. So let me break this one down a little bit further to give you a better idea of how this actually works. So DSCR loans, these are the investor's workaround. If your goal is to buy a new Airbnb investment, consider using this type of loan. The lender's going to qualify the property, not you personally, based on projected rental income. They're going to look at the gross monthly rent and then divide that by the monthly payment. Gross rent equals the market rent from an appraisal or lease or projected Airbnb income, and then your PITIA, principal, interest, taxes, insurance, and HOA fees for your monthly cost. So to give you an example, say you're buying a $300,000 rental home in Muskegon. The monthly rent is $2,400. The monthly mortgage, principal, interest, taxes, insurance, and HOA fees equals $2,200. The DSCR loan equals $2,400 divided by $2,200, which gives you a 1.09 score. So here's a general synopsis of how lenders actually interpret the DSCR score. They do it as a ratio. If it's less than 1, the property doesn't fully cover debt and it's considered more risky, which means a higher down payment. If it's between the 1 and 1.25 ratio, it's a break even to modest cash flow investment, and this is acceptable. But if it's above a 1.25 ratio, it has strong positive cash flow. This qualifies as excellent and you get the best rates and returns. So the pros to this: no tax returns or W-2 required. Cons: typically a higher rate, about 1 to 1.5% higher, and usually require 20 to 25% down. So now you can see there are programs that will qualify you if you don't have an Airbnb and you're not generating income. There is another program that will qualify you. You just have to know how to go through the loopholes and to make sure that you're doing it right. And it's obviously in your best interest to speak to some local lenders in your area to give you some further information on how this program works. This is just a very, very basic understanding of how this works. So obviously be sure to reach out to them and they'll give you some more guidance on this topic. Another option is a portfolio bank loan. Some local banks may accept Airbnb statements with at least 6 to 12 months of consistent revenue. Remember, consistent revenue. And then lastly, we have the government assisted loans, the FHA, VA, and USDA, and these don't allow for short-term rental income for qualifying. Remember in previous videos I talk about USDA, VA, FHA, these are government assisted loans. And the reason they can't qualify for Airbnb or investment properties is because these programs are for primary residences only. And their entire purpose is to help people buy or refinance a home they will personally live in, not investment or income producing properties. So right out the bat, we know that they are not designed for investment homes or short-term rentals. They require you to occupy the home as your primary residence, usually within 60 days of closing and for at least 12 months. That means that the government doesn't want your qualifying income to come from a property you don't live in full time, like an Airbnb or VRBO. Now let's talk about the documentation that lenders may request for qualifying you for these types of loans. If you're counting Airbnb income, be ready to provide the following: Airbnb or VRBO host payout summaries, at least 12 to 24 months, a 1099-K form Airbnb, Schedule E from your tax returns, lease agreements if there are any, and then any bank statements showing consistent deposits. So in summary, if you're in a situation where you have an existing Airbnb with 1 to 2 years history of payments, you can use that Airbnb income to qualify for a new mortgage. And what's required? Your tax returns or 12-month Airbnb history. If you have a new Airbnb with no history, it does not qualify for conventional loans, but you can use a DSCR loan or qualify on your own personal income. If you're refinancing your existing Airbnb, this can qualify with Airbnb income for a new mortgage, but the lender will average verified income over a specific period of time. And then lastly, your FHA, VA, and USDA will not qualify for a mortgage for a new Airbnb investment property, because remember, these are for long-term rentals or for your primary residence, nothing short-term. If you've made it this far in the video, you're probably already asking the same question that many people are, and that's, you just mentioned a minute ago that you can't use a government-assisted loan to buy a rental property, and you're correct. However, there are hacks. It's called house hacking. You can actually use a government-assisted loan to buy, say, a duplex as long as you live in one side and rent the other. But you know what? That's for another video. So now let me give you a pro tip. And remember, this is here in Michigan where I live at. So obviously, if you're not from Michigan, this may be a little bit different, but hopefully it'll still provide some value to you. And again, you can always ask a local expert in your area to see if this same process would apply. So if you're buying a home in West Michigan, say a lake cottage near Newaygo, Muskegon, or Pentwater, and you want to run it part-time on an Airbnb, you can still get a second home loan, 10% down, with a lower rate if you personally use it most of the time. And now that's the key right there, most of the time. Just don't count the Airbnb income to qualify. Later, once you've built 12 months of history, you can refinance and use that income for future purchases. So the bottom line is this: Airbnb income can help you qualify, but only once it's proven stable. If it's new or untested, you need to qualify using your own income or choose an investor-friendly DSCR loan. So there you have it in a nutshell. Hopefully you got some value out of it. As always, be sure to drop me a like, comment, and smash that subscribe button. And listen, before you go, if you want to know how to buy a house in a high inflated economy, I got your back. Check out that video right there. I'm sure it'll help you out. With that being said, see you on the next video. Take care.